Okay, let's unpack this. Bitcoin just went through its fourth halving back in April. Now, if you were watching, you might have expected one of two things. Either the price instantly shoots to the moon, right, because new supply is cut in half.
Classic expectation. Yeah.
Or maybe, just maybe, the miners, the guys securing the network, suddenly find themselves totally unprofitable, start shutting down machines.
Which also seems plausible, given the economics.
But here's where it gets really interesting, a little paradoxical even. Right after this huge scheduled event, this moment of increased scarcity, the price, well, it largely stabilized, kind of flat. And at the exact same time, we saw transaction fees on the network just absolutely explode. I mean, levels we've never, ever seen before.
That part was wild.
It's this weird contrast, isn't it? Price stability on one hand and this like fee frenzy happening simultaneously. And that really opens up a whole can of worms about what's really going on under Bitcoin's hood. It even raises some, fundamental questions about its long-term security model.
It's a fascinating moment, exactly, because it kind of defied those simpler predictions. It highlighted just how complex the whole system is. It wasn't just one domino falling. It was a whole series of ripple effects playing out in real time.
Right. And that's why we're taking this deep dive of diving deep into this recent Bitcoin halving from April 2024, exploring all these multifaceted impacts. We've gathered quite a stack of sources to guide us.
Good stuff, hopefully.
Yeah, we've got analysis from Cointelegraph Research, really focusing on the mining industry, its resilience, that sort of thing. Market insights from Investopedia, covering the price action and that unexpected fee spike.
Okay.
A look at the evolving regulatory landscape for miners. That's from Easy Blockchain. Some raw community perspectives, market chatter from Reddit. Always interesting.
The Reddit rabbit hole, yes.
And perhaps most compellingly, some real academic heavy lifting. A research paper shared via Orbilu that delves into the deeper, maybe less discussed security implications of this whole programmed event.
So looking beyond the immediate market moves.
Yeah, exactly. So our mission today is to distill these sources, find the crucial nuggets of information, and really build a picture of what this latest halving truly means. Not just for the price chart everyone watches, but for the miners, right? This complex, energy-intensive industry securing the network, for how governments around the world are reacting, and yes, for the fundamental security properties of Bitcoin itself. This is about getting you thoroughly informed on what's a really critical transition point for the network. Quickly, and, without getting lost in all the noise.
Sounds like a plan. Where do we start?
So let's start with a quick refresher. Because while many people following Bitcoin know about the halving, understanding exactly what it is really sets the stage. What is a Bitcoin halving at its core? And what specific numbers changed back in April 2024?
Absolutely. So at its heart, the Bitcoin halving is it's a programmed event. It's written right into Bitcoin's code by its creator, Satoshi Nakamoto. Right. It's fundamentally a deflationary mechanism.
Built-in scale.
Precisely. Roughly every 4 years, or more specifically, every 210,000 blocks that get mined and added to the blockchain, the reward that miners receive for finding a new block is cut exactly in half.
Okay.
This gradually reduces the rate at which new Bitcoin is created, introduced into the market. It reinforces that core principle of scarcity and ensures the total supply will eventually definitely be capped at 21 million coins. That's the hard limit.
It's like the tap of new supply just gets turned down a notch on a fixed, predictable schedule.
Exactly like that, a predictable tightening. And the most recent instance, the fourth halving, occurred specifically on the evening of Friday, April 20th, 2024. That was when block number 840,000 was mined. The network officially transitioned into its fifth epoch then.
Epoch 5. Okay. Yeah. And the direct consequence for miners in that exact moment, what changed for them instantly?
The block reward. The amount of new Bitcoin they earned for successfully adding a block to the chain was instantly reduced. It went from 6.25 Bitcoins per block.
Which it had been for 4 years.
Right. Down to 3.125 Bitcoins per block. Just like that. That's the mechanism. Having the issuance rate.
So you have this hard, predictable, pretty significant reduction in the supply of new Bitcoins hitting the market. And historically, as we mentioned, this has been followed by some pretty explosive price rallies, hasn't it?
It has, yes.
So what happened right after this halving event in April 2024? What did the price do?
Yeah, this is where those Investopedia insights get really interesting. Because while that historical pattern suggests a dramatic move, the immediate aftermath saw the Bitcoin price initially, stabilize. It didn't surge immediately, nor did it crash. It just kind of held relatively steady right around the halving point.
Stable. That feels, counterintuitive, doesn't it, if you're cutting supply?
It certainly wasn't the immediate moonshot some speculators might have been hoping for, no. Though it's important to note the sources do say that within a couple of days, by Monday, April 22nd, Bitcoin had started trading higher again. It moved back above the $66,000 level. So that stability was very short-lived before an upward trend seemed to resume.
Okay, so not an immediate explosion, but not a collapse either. A brief pause, then up. Why that initial stabilization, though? Compared to history, our sources seem to bring up a couple of key perspectives on this.
Right. One prominent view, and this was cited in reports from big institutions like Deutsche Bank, JP Morgan, is that the halving was likely already priced into the market well in advance.
The classic efficient market argument.
Exactly. The idea is that market participants, knowing this scheduled event was coming for years, had already factored its potential impact into their trading strategies, their positions, over the preceding months. The anticipation had, in this view, already played out in the price leading up to April 20th. The event itself was perhaps less impactful than the run-up.
Makes sense. It's the buy the rumor, sell the news kind of idea, but for a supply event. But then you can't ignore the past, can you? That historical data is pretty compelling.
It is incredibly compelling. And that historical context is exactly why many did expect a major move, perhaps more quickly. After the first halving back in 2012, Bitcoin's price saw just an incredible surge, something like 9,300% over the next 13 months.
Wow.
The 2016 halving. That led to about a 2,860% increase over 17 months. And the most recent one before this, in 2020, was followed by a roughly 620% rise over about 11 months. These weren't small bumps. They were, multi-month, pretty parabolic trends.
Okay, so you've got this tension, the priced-in argument versus this really powerful historical track record. And of course, the standard disclaimer always applies, right? Past performance is never a guarantee of future results.
Never. Essential disclaimer.
And you see this tension playing out in the community discussions too, don't you, on places like Reddit?
Oh, absolutely. The Reddit discussions we looked at capture this perfectly. There was just tons of speculation blending that historical analysis with the current market conditions. We saw these napkin math posts, people trying to project future price peaks based on previous cycles.
Like what sort of numbers were they throwing around?
Well, one popular piece of analysis suggested a potential 162% price increase post-halving this time, with a possible peak maybe around 420 days out.
420 days. That would put it when?
Let's see. Based on the April 2024 halving, that would land somewhere around June 13th, 2025. Just an estimate, of course. Other predictions we saw on Reddit pointed towards November 2025. So you see the community actively debating these potential future trajectories, trying to map history onto the present.
Fascinating. It's that blend of data and, let's be honest, a fair bit of hope and speculation. But beyond the history and the priced-in debate, there's a genuinely new factor in play this time around, something that wasn't there during the previous halvings.
Yes, a very significant one. It adds a whole new layer of complexity. The introduction of spot Bitcoin exchange-traded funds, the ETFs, in the U.S. market earlier this year.
Right, the big Wall Street entrance.
Exactly. These ETFs give large institutional investors, traditional finance players, a regulated, easy way to get exposure to Bitcoin. They don't have to worry about custody or setting up wallets.
So how could that influence the price dynamics after the halving? Does it help or hurt the historical pattern?
Well, that's the million-dollar question, isn't it? It's adding a really unpredictable element. One perspective is that these ETFs could actually act as a stabilizing force.
Stabilizing? How so?
Well, think about it. If Bitcoin's price were to shoot up too quickly, maybe mimicking those past parabolic runs, these large funds, they have mandates, allocation targets, they might need to rebalance their portfolios. That could mean selling some Bitcoin to maintain their target weightings.
So institutional selling could act as resistance?
Potentially.
Yeah.
It could temper or slow down the kind of rapid, sustained rallies we saw historically, like a kind of speed bump, as you put it earlier.
Okay.
However, there's also the opposite argument. What if there are massive inflows into these ETFs?
Yeah.
Driven by new institutional demand.
Right. Big money deciding to get in after the halving.
Exactly. If large funds decide to enter or significantly increase their positions post-halving, the sheer volume of Bitcoin they might need to acquire could just overwhelm the already reduced supply rate from miners. This could exaggerate upward price moves, potentially pushing the price up far beyond what individual retail investors might cause.
So the ETFs could either dampen the rally or supercharge it.
Precisely. The sources present this as a key new variable. It just makes predicting the exact post-halving price trajectory much more complex than simply looking at the history books. It's a new game in some ways.
Okay, so initial price stability, a slight rise, the priced-in debate swirling, and this big ETF question mark hanging over the long-term price impact. That's one immediate effect of the halving. But the other, maybe more surprising immediate effect you mentioned, that sudden dramatic surge in transaction fees.
This was the really big story in the hours and days right around the halving itself. It was covered extensively, especially by Investopedia. While the price was relatively calm, the cost of actually sending a transaction on the Bitcoin network just went through the roof.
What was driving that? I mean, why would fees spike so dramatically right then?
The overwhelming consensus across the sources, pretty much everyone agrees, is that this spike was driven almost entirely by the launch of a new protocol called Runes.
Runes. Okay, I've heard of ordinals, inscribing things on Bitcoin. Is this related?
It is related. It builds on that concept. Ordinals allow data like images or text to be inscribed on individual satoshis, the smallest units of Bitcoin. Runes is a system that goes a step further, allowing for the creation and issuance of new fungible digital tokens, think like altcoins or meme coins, directly on the Bitcoin blockchain's base layer.
Okay, so people could suddenly create and trade new kinds of crypto tokens, using the Bitcoin network itself as the settlement layer.
Exactly. And the kicker was, the launch of this Runes protocol was specifically timed to happen right at the halving block 840,000.
Ah, clever timing. Or chaotic timing.
Both, maybe. It created an absolute frenzy. You had users, developers, everyone wanting to mint the very first runes, especially those tied to potentially valuable or popular names like short tickers. They were all fighting to get their mint transactions included in that halving block and the blocks immediately after, as quickly as possible.
And the way you get your transaction included quickly on Bitcoin
Is by paying a higher fee to the miners. You essentially outbid everyone else for that limited block space.
Ah, okay. So it just became a massive bidding war for block space driven by this runes gold rush.
Yeah.
How high did the fees actually go? Was it just a little bump?
Oh no, not a little bump at all. The spike was unprecedented. According to data from Kaiko Research, cited in that Investopedia piece, the average transaction fee on the Bitcoin network surged to an all-time high the day after the halving.
All-time high, higher than the 2017 peak.
Higher. It was reportedly more than 7 times the average rate of the day before the halving, and it doubled the previous record high, which was set way back during the market peak in December 2017.
Wow. 7 times higher than the day before and double the previous all-time record. That's an incredible amount of demand, of competition for block space.
It really shows just how much demand there was to use the network at that specific moment, specifically driven by the Runes launch. And we saw a really vivid illustration of this with ViaBTC. They were the mining pool that successfully mined the actual halving block 840,000.
Okay, so they got the prize.
They did. And that single block, it didn't just contain the normal transactions, it was packed with all those high-fee, Runes-related minting transactions. In total, ViaBTC earned over 40 Bitcoins from that one single block.
40 Bitcoin, but the subsidy was only 3.125.
Exactly. They got the new halved 3.125 BTC block subsidy, plus nearly 37 Bitcoin just in accumulated transaction fees from that one block alone.
That's insane. It really highlights just how dominant the fee component was in that specific moment. That's far, far more than they would have earned from a block before the halving, even with typical fees.
It's a really stark demonstration of the potential power of transaction fees to generate revenue for miners. And this spike, while maybe temporary, maybe driven by hype, it's actually highly relevant to the long-term health and security discussion around Bitcoin.
How so? Why does a temporary fee spike matter long-term?
Well, as we mentioned earlier, that block subsidy, the reward of new Bitcoin for miners, it gets cut in half roughly every 4 years. It's going to continue to decrease, getting smaller and smaller, until it eventually disappears entirely. That's projected to happen around the year 2140.
At the subsidy cliff?
Right. At that point, the only incentive for miners to spend energy securing the network will be the transaction fees paid by users. The security of the network will rely solely on those fees.
Okay.
Protocols like Ordinals, and now Runes, by creating new use cases, new reasons for people to want to transact on Bitcoin's base layer, they show that it is possible to generate significant fee revenue. They create demand for that block space.
So the thinking is, if these new applications on Bitcoin's base layer become popular, if they consistently generate high transaction fees, that revenue could potentially replace the diminishing block subsidy over time. and keep miners incentivized.
That's the bull case for long-term security, yes. If demand for block space remains consistently high, the fee market could evolve to provide the necessary security budget for the network.
Yeah.
However, there's a counterpoint, a potential trade-off.
Which is?
If base layer fees become consistently too high, prohibitively expensive for just sending regular payments, it could push more and more typical transaction activity onto layer 2 networks like the Lightning Network or various side chains, places where fees are much, much lower.
So high fees could drive users away from the main chain.
It could create this dynamic tension. You need high enough fees on layer 1 to secure the network long-term, but not so high that you kill demand for using layer 1 for anything other than these specialized high-value transactions like runes mints or ordinal inscriptions. The runes frenzy gives us a glimpse into the potential for high fees, but whether that kind of demand persists or whether it ultimately pushes users towards layer 2 solutions, that's the big open question the sources discuss.
Okay, that makes sense. So the halving impacted both the potential long-term price trajectory with all that history, the priced-in arguments, the ETF wrinkle, and the immediate revenue stream for miners, with the subsidy cut being partially, maybe temporarily, offset by that surprising fee spike. This leads us directly to the group most directly hit by that reduced block reward, the Bitcoin miners themselves. What's the new reality for them post-halving?
Yeah, for miners, the post-halving world is significantly more challenging, just purely from a profitability standpoint. Their main source of income, the block subsidy, was just instantly cut in half. We see this reflected really clearly in key industry metrics like hash price.
Hash price. Remind us what that measures.
It measures the expected daily revenue a miner can earn for a given amount of computing power, usually measured per terahash per second, THS. It's like, how much money does my machine make per unit of work?
Got it. And what happened to hash price?
The Cointelegraph source notes that hash price dropped sharply. It went from around 0.12, maybe 12 cents per terahash per day in April 2024, just for the halving, down to roughly 0.049, let's say 5 cents by April 2025.
Wow, less than half the earning potential for the same amount of computational effort. That's a steep decline.
It is. And it happened at the same time that the network difficulty, which, remember, adjusts to keep blocks found roughly every 10 minutes, no matter how many miners are competing, surged to an all-time high, around 123 trillion, 123 T.
So it's harder than ever, computationally, to actually find a block. And the reward for finding one is now half what it used to be.
Exactly. Less reward per block, and it's significantly harder to find that block in the first place. If transaction fees hadn't spiked like they did with runes, that initial halving moment would have translated to an immediate, roughly 44% drop in miner revenues just overnight.
That sounds like a really harsh economic environment. What's the absolute core necessity for a miner to survive, to stay profitable in this new reality?
The Cointelegraph analysis makes it crystal clear. Efficiency is everything. It's no longer optional. It's an absolute necessity. To remain profitable, miners have got to extract the absolute maximum value, the most hashes, for every single watt of electricity they consume.
Every watt counts.
Every single watt. Power costs and hardware efficiency, they've always been critical in mining, but post-halving, they are absolutely paramount. Margins are just so much thinner now. Every bit of wasted energy, every inefficient machine, it hurts the bottom line significantly more than it did before.
And this is what drives that constant mining arms race we hear about, right? The push for better and better hardware.
Exactly. That competition to acquire and deploy the most power-efficient mining hardware has definitely intensified post-halving. We're talking about the latest generation of ASICs, those application-specific integrated circuits. These are the specialized computers designed only for Bitcoin mining, nothing else.
What kind of performance are these newest machines actually achieving? What makes them better?
Well, the leading manufacturers, companies like Bitmain, MicroBT, they're constantly pushing the boundaries. Bitmain's Antminer S21 Plus SiC, for example, that boasts a hashing power of 216 terahashes per second, 216 THs.
Which is a huge amount of computations.
Huge. And crucially, it does it with an efficiency rating around 16.5 joules of energy per terahash, JTH. Lower JTH is better. It means more hashes, more computational work per unit of energy consumed.
Okay, 16.5 JTH. And the competition.
MicroBT's WhatsMiner M66S Plus AT, which sometimes uses advanced cooling techniques like immersion cooling, where the whole machine is submerged in a special liquid. That achieves similar, or maybe slightly better efficiencies, around 17 JTH in some configurations. These numbers represent this continuous improvement cycle, just constantly trying to wring more hash power out of less electricity.
And these efficiency gains, They rely heavily on advances in the underlying semiconductor technology, right? The chips themselves.
They absolutely do. The innovation in the miners is really driven by the cutting-edge capabilities of the big semiconductor giants, like TSMC in Taiwan and Samsung in South Korea. They're the ones manufacturing the incredibly advanced chips that power these ASICs.
What kind of chip technology are we talking about now?
We're already seeing 3-nanometer chip technology being deployed in the very latest miners, and 2-nanometer technology is on the horizon. These smaller process nodes, they allow chip designers to pack more transistors onto a single chip, which leads to significant improvements in computing power per watt. It's fundamental physics driving mining efficiency.
Okay, so miners need the latest, most expensive, most efficient machines, and they need the absolute cheapest possible electricity to run them. This has to be causing shifts in where the big, large-scale mining operations are choosing to set up shop globally.
Absolutely. That search for low-cost, reliable power is probably the single biggest driver of geographical shifts in the mining industry right now. It was already happening, but the halving just accelerates it. Regions that can offer really cheap electricity and, ideally, a favorable regulatory environment are becoming the new global hubs for institutional-scale mining.
Can you give us some specific examples from the sources? Where are these operations moving or expanding?
The Middle East comes up frequently in the sources as a prime example. In Oman, for instance, licensed Bitcoin miners can reportedly access electricity at rates between 0.05 and 0.77 per kilowatt hour. And that's often with government subsidies designed specifically to attract this kind of high-tech investment.
5 to 7 cents a kilowatt hour. That sounds pretty low compared to, say, residential rates in many places.
It is, and it gets even lower.
Right.
In the UAE, the United Arab Emirates, there are reports of semi-governmental projects operating at even lower rates, potentially down in the 0.035 to 0.045 cents per kilowatt hour range, 3.5 to 4.5 cents. These incredibly low energy costs offer a massive competitive advantage, especially after the halving cut the revenue side.
Okay, 3.5 cents. How does that compare to a place like the U.S.? The U.S. saw a lot of mining capacity move there after China's big crackdown a few years ago.
Right, the U.S. became a major hub. But in many parts of the U.S., industrial electricity rates are considerably higher, often exceeding 10 cents per kilowatt or 10 cents or more. At those prices, post-halving, the profit margins for miners using anything but the absolute latest, most efficient gear are severely squeezed, maybe even negative.
So that cost difference is pushing miners out of the U.S. now?
It seems to be forcing a migration, or at least a strategic evaluation. This cost disparity is making some U.S.-based operations look very closely at the economics and potentially consider relocating, or at least expanding, into these more cost-efficient international locations. The hunt for cheap power is global.
So the chase for cheap energy is creating these new kind of battlegrounds for mining globally.
It really is. Regions in Africa, the Middle East, and Central Asia are becoming increasingly important. They offer opportunities for what's called energy arbitrage, basically, finding locations where energy is abundant, maybe underutilized, and therefore particularly cheap. It's also worth mentioning El Salvador's unique approach here, which connects to the regulatory side we'll discuss.
Oh, yeah. What are they doing differently?
Well, the government there isn't just trying to attract miners with cheap energy. They've stated plans to actually reinvest the tax revenue they generate from mining operations, taxing their energy consumption into developing new, greener energy sources, like geothermal from volcanoes.
Using mining taxes to fund green energy. That's interesting.
It's an attempt to align the significant energy demands of mining with their national sustainable development goals, and potentially expand their overall national energy capacity using mining as a catalyst. It's a very different model.
Okay, so despite all these pressures, the halved reward, the rising difficulty, this intense need for efficiency driving geographical shifts, what actually happened to the total computing power securing the network, the global hash rate? Did it drop off a cliff after the halving as the less efficient miners presumably shut down?
This is where the resilience of the industry, or maybe the preparedness of the big players, really becomes evident. Surprisingly, and perhaps defying some expectations of a massive miner capitulation, Bitcoin's network hash rate has actually continued to climb significantly post-halving.
Really? It went up?
Overall trend, yes. The Cointelegraph source notes that as of May 1st, 2025, so looking back over the year after the halving, the hash rate had reached 831 exahashes per second a D, and it had actually peaked earlier at a staggering 921 EHs.
921 EHs, that's an astronomical number. What was the low point leading up to that, back in 2024?
That recovery represents a really substantial climb. It's a 77% increase from the 2024 low point, which was around 519 EHs.
Wow, a 77% increase in total network computing power after the reward was cut in half. How do you explain that?
It underscores a couple of key things we've touched on. First, that relentless drive for efficiency. Old machines get replaced by new ones that produce way more hash per watt. So even if some miners drop off, the new gear adds more hash power than was lost. And second, it shows that the large, well-capitalized mining firms were actively reinvesting. They were upgrading their fleets with the latest, most efficient hardware, optimizing their operations, basically preparing for this exact scenario to remain competitive despite the lower block reward. They likely planned for this well in advance.
They saw it coming and invested heavily to survive and thrive. And on the business side, how have the publicly traded mining companies, the ones whose stocks you can buy, how have they fared through this transition? Did their stocks crash?
Interestingly, no, not broadly. The Investopedia source mentioned that shares of several major publicly traded U.S. miners, companies like Riot Platforms, Hut 8, Marathon Digital, actually traded substantially higher in the period following the halving.
Higher. Why would that be?
It suggests market confidence, perhaps. Investors might believe that these large public companies, with their scale, their access to capital markets for funding upgrades, maybe their favorable long-term power contracts, that they're well-positioned to navigate the new economic reality, perhaps even gain market share from smaller, less efficient players who might struggle.
Less survival of the fittest scaled up?
Possibly. Some sources also floated another interesting idea: diversification. As traditional Bitcoin mining revenues get tighter, some of these operations, which have built massive data centers full of powerful computers and secured cheap power, they might start exploring diverting some of that computing capacity towards other high-demand areas, like artificial intelligence.
These AI. Using mining rigs for AI.
Well, AI training and inference also require immense computational resources. It's possible some mining companies might see an opportunity to leverage their existing infrastructure. The buildings, the power connections, the cooling systems for the booming AI industry, potentially diversifying their revenue streams beyond just Bitcoin mining. It's a fascinating potential strategic shift.
Definitely one to watch. Okay, so miners are adapting, racing for efficiency, chasing cheap power around the globe. The hash rate remains surprisingly high. This intense focus on power naturally brings us to the whole regulatory landscape. As mining has grown into this massive global industry, government attention has grown too, right?
Absolutely. You can't have an industry consuming potentially country-sized amounts of electricity without attracting scrutiny from governments worldwide. As Bitcoin mining has scaled up, it has increasingly come under the regulatory microscope, leading to growing calls for oversight and rules.
And what are the main reasons governments are getting interested? What concerns are driving this regulatory push?
The sources we looked at highlight three primary drivers. First, the usual concerns around consumer protection, preventing fraud, that sort of thing. Second, governments are, naturally, interested in capturing revenue. They see a potentially profitable industry and want to figure out how to tax it effectively.
Makes sense.
And third, perhaps the most significant driver recently is environmental concerns. Specifically, the large and sometimes rapidly growing energy consumption of the proof-of-work mining industry. That's become a major focus point in policy debates.
Okay, let's look at the U.S. context first. The regulatory picture there seems, well, complicated. Lots of different agencies involved.
It is quite complex. While a lot of the U.S. regulatory focus on crypto has centered on exchanges, trading, stablecoins, things like that, regulation specifically concerning mining is definitely gaining traction. You have numerous federal agencies that could potentially claim some jurisdiction or have an interest. You mentioned the SEC, the CFTC, the FTC for consumer protection, the IRS for taxes, the OCC for banks, FinCEN for money laundering.
It's an alphabet soup.
It really is.
Yeah.
And this creates a kind of patchwork where jurisdictions and interpretations can sometimes overlap or leave gaps.
So is there a single clear federal law in the U.S. right now that says this is how Bitcoin mining is regulated? Like, is it explicitly legal or illegal federally?
Currently, no. There isn't one explicit federal law in the United States that either prohibits Bitcoin mining nationwide or definitively confirms its legality and sets out specific rules for it. This absence of a specific federal statute has largely left the door open for individual states to take the lead and adopt their own approaches, their own regulations regarding mining operations within their borders.
Okay, so the real action, the specific rules for miners, that's happening more at the state level then.
That's definitely where we see the most specific policy development concerning mining itself. And it's not all negative regulation either. Some U.S. states are actively taking steps to encourage Bitcoin mining, often through legislative incentives designed to attract these businesses.
Really, which states are doing that, and why would they want to attract such an energy-intensive industry?
States that were cited in the sources as having legislation or initiatives aimed at encouraging mining include places like Rhode Island, Kentucky, Iowa, Montana, Wyoming, and also various U.S. territories. Their motivations are primarily economic.
Jobs and taxes.
Exactly. They see attracting these large-scale mining operations as a way to generate significant tax revenue, potentially create some high-tech jobs, though mining isn't hugely labor-intensive, and importantly, increase revenue for their local public utility providers, especially through the substantial, consistent energy consumption these facilities represent. They're big customers for power companies.
Can you give an example of the kinds of incentives or laws these states are passing?
Sure. Montana, for instance, reportedly used state grant money to support a specific mining project, and also passed laws that specifically exempt certain cryptocurrencies from state securities laws, which reduces regulatory hurdles for crypto businesses operating there, including miners. Wyoming has been particularly active. They've passed a suite of laws creating a very favorable environment, including exemptions from state securities and money transmission laws for certain digital asset activities, effectively creating a regulatory sandbox to attract crypto innovation, mining included. Pennsylvania also has laws that indirectly encourage mining by leveraging its existing energy infrastructure.
So these states are basically competing with each other and internationally to attract this industry, seeing it as an economic opportunity.
That seems to be the case, yes. They're creating these favorable regimes to try and capture that investment and tax base.
What about taxes specifically on mining income in the U.S.? That sounds like it could get complicated, especially with Bitcoin's price constantly changing. How does the IRS treat it?
It is, as one source put it, a bit of a sticky business. But the IRS has provided guidance. Essentially, the income you earn from mining Bitcoin is considered taxable income. Standard stuff there.
Okay, so how do you calculate it?
You report it as ordinary income based on the fair market value of the Bitcoin you receive on the day you receive it. So the day you successfully mine it and it hits your wallet. If you mine, say, 3.125 BTC today, you look up its dollar value today, and that dollar amount is your gross income for that mining activity.
Okay, that's the first tax event when you receive it. Is there another one later?
Yes, potentially. The second taxable event occurs later if and when you sell that mined Bitcoin. Selling it triggers a capital gains or losses event, just like selling stock.
How is that calculated?
You calculate your gain or loss based on the difference between the price you sold it for and your cost basis. Your cost basis is generally the fair market value of the Bitcoin back when you originally mined it. The value you already reported as income, potentially minus certain direct costs associated with mining that specific Bitcoin, that can get complex. That gain or loss is then subject to capital gains tax rates, which depend on how long you held a Bitcoin.
So you're taxed on the value as income when you get it, and then taxed again on any price appreciation when you eventually sell it.
Correct. First is income, then later as a capital asset when it's disposed of. It's important to note, though, there's a key distinction for tax purposes between commercial mining operations businesses and individual hobby miners. Commercial operations can deduct significant business expenses, things like their massive electricity costs, the depreciation of their expensive ASIC hardware, rent for facilities, operational overhead. These deductions can substantially reduce their overall taxable income. Hobby miners, on the other hand, face much stricter limits on deducting expenses, making it harder for them to offset their mining income.
Right, the standard business versus hobbyist distinction. Makes sense. Okay, let's zoom out and look internationally again. How do these U.S. approaches, this state-level competition and federal patchwork, compare to what other major countries have done? We mentioned China earlier.
Yeah, the contrasts globally are quite stark sometimes. China, as we discussed, went from being the absolute dominant force in Bitcoin mining, hosting well over half the global hash rate just a few years ago, to implementing a strict crackdown. This forced a massive sudden migration of miners out of the country, primarily to places like Kazakhstan, Russia, and yes, the U.S.
What were China's stated reasons for that drastic crackdown? Was it just energy?
Their official rationale seemed multifaceted. Energy consumption was definitely part of it. There was a significant blackout in a mining-heavy region that got highlighted publicly. But their specific regulations often targeted crypto exchanges and financial stability risks, rather than solely focusing on mining taxes or energy use directly. Concerns about capital flight, financial stability, preventing speculation, and maintaining control over the financial system were likely major factors too.
Okay. And Kazakhstan, which took in many of those displaced miners.
Kazakhstan initially rolled out the welcome mat. They saw an economic opportunity and became a major destination for miners fleeing China. They actually legalized crypto mining and transactions back in 2020, viewing it as an economic boon. They even amended their tax code to specifically tax mining operations based on their energy consumption, trying to capture revenue from it.
Sounds positive initially, but then it.
But then the sheer scale of the influx overwhelmed their national energy grid. The rapid growth of mining put immense strain on their power infrastructure, leading to electricity shortages and grid instability, especially in certain regions. This has raised serious concerns that Kazakhstan might face pressures similar to what China cited, potentially leading them towards future restrictions if that energy demand isn't managed effectively. It highlights the infrastructure challenge.
And Iran also had issues with energy strain leading to mining bans, right?
Yes, Iran provides another example. They imposed temporary bans on Bitcoin mining, particularly during peak summer months when energy demand is highest for air conditioning, and later moved towards a licensing regime. The primary driver, again, was the intensive energy consumption of mining, contributing to electricity blackouts during periods of high national demand.
So it really seems like there's a recurring theme running through these international examples, doesn't it?
There absolutely is. A key takeaway from the sources is that the intensive energy consumption associated with large-scale proof-of-work mining tends to be the primary factor that pushes governments towards stricter regulations, or even outright bans. This happens even in countries that were initially welcoming or neutral towards the industry if that energy demand starts to strain the national grid or conflict with other energy policy goals. Managing the energy footprint is the critical policy challenge for mining globally.
Are there countries where Bitcoin mining is just flat out illegal? No ambiguity.
Yes, the sources we looked at noted several countries where Bitcoin mining is considered illegal outright. Examples given included Bolivia, Ecuador, Egypt, and Algeria.
Okay. And just briefly, what about mining pools? Where lots of individual miners combine their computing power. How does regulation apply to them? They seem kind of distributed.
Mining pools definitely add another layer of complexity to the regulatory picture, because they coordinate potentially thousands of miners located all across the globe, all contributing hash power to the pool operator's central coordination point.
Right, they're inherently international.
Exactly. Since the pool operates as a shared network, often coordinating miners from many different legal jurisdictions, figuring out which specific country's regulations apply to the pool operator themselves can be, as one source put it, murky. This distributed nature can sometimes allow pools to operate in ways that navigate around certain local energy cost structures or specific regulations, although the sources didn't suggest this is a major loophole that's expected to change dramatically anytime soon. It's just another example of how the decentralized global nature of the network complicates traditional, geographically bound regulatory frameworks.
Fascinating. Okay, this brings us to what I personally found to be the most surprising and maybe even a little unsettling part of this whole deep dive. This comes mainly from that academic paper you mentioned earlier. The idea that the halving itself, this programmed, anticipated event designed for scarcity, could potentially introduce unexpected vulnerabilities into Bitcoin's fundamental security model.
Yes, that research, shared via Orbilu, presents a really compelling and perhaps a counterintuitive argument. They start by acknowledging the basics. Bitcoin's security fundamentally relies on its proof-of-work consensus mechanism, miners expending energy to solve that cryptographic puzzle, and crucially, its difficulty adjustment mechanism, the DA.
Right, and the DA is the key part that keeps the average time to find a new block stable, right, around 10 minutes. It makes the puzzle harder if lots of miners join and easier if miners leave to keep that 10-minute target.
Exactly. The DA is designed to be adaptive, to smooth out fluctuations in the total network hash rate over time. However, the core argument of the paper is that while the DA handles gradual changes relatively well, it can struggle to respond effectively during periods of sudden, pronounced volatility in the hash rate. And events like the halving, they argue, are particularly potent triggers for this kind of volatility.
Why the halving specifically, more so than just, say, a big price crash?
Their argument is that the halving is uniquely effective at triggering these potential instabilities because it's a sudden, predictable, and universal cut to a primary component of miner revenue, the block subsidy. Unlike a price drop, which affects revenue but might be temporary or unevenly felt, the halving instantly halves that base reward for everyone at the exact same moment.
Okay.
This sudden economic shock can, according to the models presented in the paper, make a very large percentage of the network's miners, specifically the least efficient ones, or those paying the highest electricity costs, suddenly unprofitable, basically overnight. One model they ran suggested that at a hypothetical $60,000 Bitcoin price and a common $5 per kilowatt hour electricity cost, potentially up to 80% of the network's total hash rate could become unprofitable immediately following the halving event.
80%, that's huge. So that would lead to a massive, rapid drop in the total hash rate as those miners switch off.
That's the prediction from the model, yes. A significant and rapid drop in the total network hash rate. But here's the crucial interaction. The difficulty adjustment mechanism only recalculates every 2016 blocks, which is roughly every 2 weeks.
There's a delay.
Exactly. The problem is the mismatch in timing. The hash rate can plummet today, right after the halving, but the network's difficulty level, how hard the puzzle is, remains stuck at its high pre-halving level for potentially up to 2 weeks.
So during that 2-week window, mining is suddenly much less rewarding because the subsidy is halved, and it's still just as hard computationally as it was before.
Precisely. Mining becomes much less profitable, maybe even deeply unprofitable, for a large swath of the remaining miners during that period. This puts even more pressure on marginal miners to shut down, potentially causing the hash rate to drop even further during that 2-week high difficulty window. It's a particularly tough time to be a miner.
Okay, so it's a period where mining is especially hard and unrewarding. What happens next when the DA finally does adjust after 2 weeks?
Well, this is where the potential for oscillations comes in. At the end of that difficult 2-week cycle, the DA finally recalculates. Because blocks were being found much slower during the preceding period, due to the lower hash rate, the DA algorithm will react by drastically lowering the difficulty, making the puzzle much easier to solve.
Okay, so mining suddenly gets easier.
Much easier.
Yeah.
And this sudden drop in difficulty, potentially combined with any ongoing transaction fee revenue, can make mining significantly more profitable again, almost overnight. This profitability surge can then draw hash power back to the network. And here's the key. The paper suggests it might draw back more hash rate than was present even before the initial post-halving drop.
More? Why more?
Because the difficulty might be so low temporarily that even older, less efficient mining machines, which were maybe sitting idle, suddenly become profitable again, just for that short period. So you get an overcorrection, a surge in hash rate.
Okay. So it overcompensates on the way down and then overcompensates on the way back up.
It's exactly. The paper's model predicts this can lead to an oscillation cycle. 1, halving causes sharp hash rate drop. 2, difficulty stays high for 2 weeks, low profitability. 3, DA drastically lowers difficulty. 4, profitability spikes, hash rate surges back, potentially overshooting the stable level. 5, next DA, 2 weeks later, sees the high hash rate and significantly increases difficulty to compensate. 6, this makes mining less profitable again, potentially triggering another hash rate drop, and the cycle repeats.
Creating these alternating periods of really high difficulty and really low difficulty, driven by these swings in hash rate.
Precisely, and crucially, the periods of significantly lower total hash rate occur during those high difficulty epochs within this potential cycle. The paper also notes that this kind of oscillatory behavior, this positive feedback loop between hash rate and difficulty adjustments, isn't just theoretical. It's actually been observed empirically on other cryptocurrency chains, particularly forks of Bitcoin like Bitcoin Cash, especially around their own halving events.
Okay, so it's a known phenomenon in similar systems. What's the actual security risk here? Why does a temporarily lower hash rate matter so much?
It matters because the security of Bitcoin against certain attacks, specifically the dreaded 51% attack, is directly proportional to the currently active total hash rate.
Remind us what a 51% attack is.
A 51% attack happens when a single entity, or a coordinated group of attackers, manages to control more than half, 51% or more, of the network's total computational power, the hash rate. With that dominant power, they could potentially do malicious things like prevent legitimate transactions from confirming censorship, or worse, execute double spend attacks where they spend the same Bitcoin twice, effectively counterfeiting.
Okay, that sounds bad. How does the oscillation make that easier?
If the network enters one of these low hash rate periods during the high difficulty phase of the oscillation cycle, the paper's model suggests that total network hash rate could potentially decrease dramatically, maybe dropping to as low as 1/3 of its stable pre-halving value.
1/3. Wow.
And these periods of reduced security, reduced hash rate, might not be fleeting. Their simulations indicated these unstable periods could potentially persist for several weeks, maybe up to 6 weeks in some scenarios.
Okay, so if the total active hash rate temporarily drops to only 1/3 of its usual level, what does that mean for an attacker?
It means the bar for launching a 51% attack is drastically lowered during that window. If the total network hash rate is only 1/3 of what it normally is, an attacker only needs to amass 1/3 of the computational resources they would have needed before the instability began in order to control over 50% of the currently active hash rate.
So the cost of attack, the amount of money or resources someone would need to spend to control 51% of the network, goes down significantly during these specific periods of instability predicted by the model.
That's the core finding of the paper regarding security risk. It argues that these halving-induced fluctuations can lower the effective cost of attack far below what you might estimate, just by looking at the total miner revenue, often called the security budget, during normal times. It's not the average hash rate over months that determines the risk of an attack today. It's the hash rate at the weakest point during these potential unstable periods.
And what happens to the hardware of those miners who shut down because they become unprofitable? Does it just sit there? Or could that contribute to the risk?
That's another important factor the paper points out, potentially exacerbating the risk. When miners with less efficient hardware become unprofitable, they might not just turn off their machines and wait. They might try to recoup some costs by selling their specialized ASIC hardware on the secondary market. Or, perhaps more critically, they might rent out their hashing power.
Rent it out. To who?
To anyone willing to pay. There are active marketplaces where you can rent hashing power by the hour or day. This means that large amounts of specialized Bitcoin hashing power could become cheaper and more readily accessible on the open market precisely during these times of potential instability. And that includes being accessible to malicious actors who might want to aggregate enough rented power to launch a 51% attack.
So an attacker could literally rent the computational power needed for an attack, potentially using the hardware of miners who were just recently securing the network.
That's the potential risk, yes. The paper provides a concrete, though illustrative, calculation based on this. They referenced the NiceHash marketplace, a well-known platform for renting hash rate. They cited figures suggesting at the time maybe around 7 exahashes per second, EHs, of rentable hash rate was available, with a rough cost estimate around $100,000 per exahash per day. Based on their model scenario, where during an unstable period, the total network hash rate might drop low enough that an attacker would only need around 200 EHs to achieve 51% control. They did a back-of-the-envelope calculation. Renting 200 EHs at $100 EH day could potentially put the cost of a one-day 51% attack somewhere in the ballpark of $20 million.
$20 million to potentially attack a network securing, over $1 trillion in value. Even if that's just a rough estimate based on a model, that figure does sound alarmingly low, doesn't it, relative to the stakes?
It certainly underscores the potential severity of the vulnerability identified by their research if the network were to enter such an unstable state. They also note that other existing factors, like the centralization that already exists to some degree within mining pools and ASIC manufacturing, as well as the possibility of more sophisticated attacks like selfish mining, could potentially further reduce the effective cost for an attacker even below that estimate.
Okay, so the academic model paints this picture of potential severe instability, leading to a significantly lowered cost of attack right after the halving. But as we discussed earlier, looking back at the actual April 2024 halving, we didn't really see a catastrophic drop in hash rate. In fact, it recovered surprisingly strongly. So how do we reconcile the model's dire prediction with the observed resilience of the network?
That's the crucial question, and the paper itself acknowledges and addresses this discrepancy. They are upfront that the full severity of the instability predicted by their theoretical model wasn't actually observed, at least not immediately, in the aftermath of the 2024 halving. They then spend time exploring several real-world factors, complexities not fully captured in the model that likely acted as stabilizing forces and contributed to the network's resilience this time around.
Okay, what are those stabilizing factors they identify? Why didn't the network oscillate wildly as predicted?
They list several potential reasons. First, simple miner inertia. Large mining operations aren't like day traders. They have significant sunken costs in infrastructure, buildings, cooling systems. They often have long-term power purchase agreements with fixed rates. They have contractual obligations. Shutting down completely and then restarting everything is costly and disruptive. This creates a strong incentive to continue mining, even if profitability is only marginal or slightly negative in the very short term, hoping things improve. This reduces the likelihood of a sudden mass exodus of hash rate the moment revenue drops.
Okay, inertia. Makes sense. What else?
Second, temporary price or fee spikes. Just like we saw with the runes frenzy right after the halving. Those unexpectedly high transaction fees provided a sudden, significant revenue boost for miners, which helped to partially offset the loss from the reduced block subsidy, at least for a while. Even temporary boosts like that can help miners weather the initial shock and avoid immediate shutdowns.
So the timing of runes might have inadvertently helped stabilize things.
It very likely played a role, yes. Third factor, speculative optimism. Some miners might continue operating even at a loss simply because they are bullish on the future price of Bitcoin. They might be willing to mine unprofitably today, accumulating Bitcoin, because they strongly believe they can sell it later at a much higher price. Although the paper does critically point out that just buying and holding Bitcoin directly might actually be a more financially effective speculative strategy than mining it unprofitably.
Right, why mine at a loss if you can just buy it?
Good question. Fourth factor, non-economic motivations and institutional behavior. Not all miners are purely profit-maximizing robots. Some might be driven by ideological support for Bitcoin and its network security, willing to mine even break-even or slightly below for philosophical reasons. Furthermore, very large institutional players or mining pools who have significant investments in the broader Bitcoin ecosystem might have strategic reasons to act in ways that maintain network stability, even if it means slightly lower short-term profits for themselves. They have a vested interest in the network's health.
Protecting their larger investment.
Exactly. And finally, perhaps most importantly, proactive preparation. The halving isn't a surprise attack. It's a known, scheduled event that happens every 4 years. Miners can and clearly do take proactive measures before it happens.
Like upgrading their gear.
Precisely. This involves strategically upgrading to the latest, most efficient hardware well in advance. It involves trying to secure the most favorable long-term power contracts they can find. It might even involve stockpiling capital or equipment in anticipation of the reduced rewards. Large miners make investment decisions knowing they need their operations to remain profitable over the multi-year lifespan of their expensive hardware, a lifespan that includes the post-halving period with its lower subsidy. They plan ahead.
Okay, so all these real-world complexities, the inertia of big operations, the luck of temporary fee spikes like runes, miner optimism, rational or not, maybe some ideology, and crucially, lots of forward planning and investment by the big players, they all likely combined to cushion the blow this time. Made the immediate post-halving period much more stable than the simplified academic model initially predicted.
Exactly. These factors seem to largely explain why the empirical observation after the 2024 halving differed significantly from the most severe predictions of the model. However, and this is important, the paper's core point about the potential for instability in the systemic vulnerabilities remains relevant, especially for the long-term picture.
How so?
Because these mitigating factors, while effective in the short term, don't necessarily solve the fundamental long-term challenge. That challenge is how Bitcoin will maintain adequate security, relying solely on transaction fees once the block subsidy dwindles to zero, likely around the year 2140. Transaction fee revenue, as we saw with runes, can be highly volatile and unpredictable. Relying only on that for the network security budget decades from now is still a major open question. The halving model highlights the kind of economic shocks the network needs to be resilient against.
Which brings us right back to that fundamental question. How does Bitcoin ensure its security in the decades to come, especially as the block subsidy gets smaller and smaller and eventually hits zero? Did the paper suggest any potential solutions or strategies to mitigate the type of vulnerability they identified looking forward?
They did, yes. They explored a few potential modifications to Bitcoin's core protocol that could, theoretically, improve stability and reduce the risks highlighted by their model. One of their core suggestions involves a significant change to how the block subsidy is reduced over time.
Instead of the big chop every 4 years.
Exactly. Instead of the current system where the reward is cut precisely in half every 210,000 blocks, that big sudden drop we call the halving, they propose what they call a gradual block subsidy reduction.
Okay, what would that look like?
It would involve much smaller, but much more frequent reductions in the subsidy. For example, they simulated a scenario with less than a 1% reduction occurring every 2016 blocks. That timing is key because 2016 blocks is the interval at which the difficulty adjustment already happens, roughly 2 weeks. So this would align the subsidy adjustments much more closely, temporally, with the difficulty adjustments.
Smoothing out the revenue changes for miners?
Precisely. It would still maintain the absolute hard cap of 21 million total Bitcoins ever being created, but it would make the decline in block reward revenue much more gradual and predictable for miners, avoiding those sudden economic shocks.
And did their simulations show this gradual approach would actually improve stability?
Yes, significantly. Their simulations indicated that this gradual reduction approach could substantially stabilize the network's hash rate compared to the current sharp halving mechanism. They found that the minimum hash rate observed during periods of stress in simulations using a gradual reduction was over 3 times higher than the minimum hash rate seen under the current halving system.
3 times higher minimum hash rate. That sounds like a big improvement for security.
It would substantially improve network security during stress periods and reduce that volatility risk. However, and it's a big however, implementing such a change would require a fundamental modification to Bitcoin's core protocol rules. It would necessitate what's known as a hard fork, which is a non-backwards compatible upgrade. Getting consensus for such a major change in a decentralized system like Bitcoin is historically very difficult and potentially highly contentious.
Yeah, changing the core rules, especially the issuance schedule, that's always a huge decision for the network. Were there any other, maybe less drastic mitigation strategies they explored?
Another idea they examined was adjusting the parameters of the difficulty adjustment mechanism itself, specifically adjusting the maximum allowed range for the difficulty change in each 2-week cycle. Currently, the difficulty can jump up or down by quite a substantial amount. The protocol allows it to range anywhere from a 75% decrease to a 300% increase, negative 75%, plus 300% in a single adjustment period.
That's a huge potential swing.
It is. The paper simulation suggests that reducing this allowed range, making the maximum possible jump up or down smaller, could also help dampen those predicted oscillations in hash rate and difficulty. This could contribute to increasing the minimum observed hash rate and therefore increasing the effective cost of attack during stress periods.
So limiting how much the difficulty can swing up or down in one go might prevent those overcorrections?
That's the idea. It would make the DA mechanism less prone to drastically overshooting in response to sudden, sharp hash rate changes. Interestingly, they also looked into whether just explicitly synchronizing the halving event precisely with a difficulty adjustment cycle would help mitigate the instability. But their simulations did not show a statistically significant benefit from just doing that alone.
Fascinating stuff. So this single programmed event, the halving, it really ripples outwards, doesn't it? It connects the core economics of mining, the incentives driving miners, the global hunt for cheap energy, the responses from regulators worried about power grids, and even leads to these deep technical research questions about the network's long-term stability, its security design, possibly even prompting discussions about changing the core protocol way down the line.
That's the essence of it, absolutely. The recent Bitcoin halving wasn't just a predictable line item on a calendar that happened to move the price a bit. It acted as a catalyst. It simultaneously impacted miner profitability, drove even more intense competition for efficiency and cheap energy worldwide, unexpectedly highlighted the role new protocol layers like runes can play in generating transaction fees, for better or worse, forced governments to continue grappling with the energy footprint and regulation of mining, and, as that research really highlights, raised some fundamental, maybe uncomfortable questions about the network's short-term stability under stress and its long-term security model as that block subsidy inevitably shrinks towards zero.
This deep dive really shows that trying to understand Bitcoin is truly a multidisciplinary exercise, doesn't it? It's so much more than just watching the price ticker. It pulls together insights from economics, from cutting-edge electrical and computer engineering, global geography and energy markets, intricate international regulation, passionate community dynamics, and even deep dives into game theory and computer science research like that paper. The whole ecosystem is just constantly reacting, adapting, evolving in response to these program changes and the powerful economic forces they unleash.
It really illustrates that Bitcoin, while often discussed primarily in terms of price speculation and investment, is fundamentally a complex, dynamic, evolving system. A system where seemingly simple design choices made years ago, like the halving mechanism, have these profound, far-reaching, and sometimes unexpected consequences across technology, economics, and policy. The halving is more than just a supply shock. You can think of it as an ongoing periodic stress test for the network's core architecture and its fundamental ability to remain secure and functional under changing economic conditions.
And that leaves us with a pretty powerful, maybe even provocative, final thought to leave you, the listener, with. It's a question that's really central to the long-term vision and viability of Bitcoin. Can its original design, specifically that fixed supply cap of 21 million coins and the eventual complete reliance on transaction fees for network security, ultimately guarantee its resilience in the very, very long run? Or, as hinted at by some of this research, will the network eventually need to consider deeper adaptations to its core mechanisms? Changes, perhaps like that gradual block subsidy reduction or tweak difficulty adjustments? Will changes like that become necessary to ensure Bitcoin remains robust and secure against the economic forces and potential vulnerabilities that events like the halving continue to illuminate? What does the answer to that question really mean for the future of digital scarcity and the evolution of decentralized networks?
It's a huge question, definitely something worth contemplating as we watch this all unfold.
Indeed it is. Well, that's all the time we have for this deep dive. Thanks so much for joining us.